Hey, welcome to Apex Trades. So we've seen the continuation of this massive pump, completely wrecking a lot of people. It's difficult when you see when your bias, at least from a TA perspective, has been quite, bearish, and then you see this retracement. The thing that I guess that struck me is when you see a sell-off like this is FTX, right? And that's perpetuated. It's one that the move starts, people start to realize there's going to be a fallout, and then it just continues to the downside, and that all happens relatively quickly. But when you see a pump like that, you have to look at what news events have created it, and it's difficult to see. It's really trying to understand, well, what was the catalysts, or was there many? Okay, you could use the CPI. I just think that's a short-term view. Personally, I think we're still really high in terms of inflation. Ultimately, the jobs data is not coming in. If anything, it's reducing. So in terms of unemployment, so that's another thing. So then you have to think, well, what else could be kind of perpetuating it? Now, there is this idea that when this difference between futures and spot, specifically on central exchanges, starts to consider being over leveraged on, so you have like 3x or 3 times long or 3 times short on the margin trading, and they also have like 5 times longs and 5 times shorts. Now obviously from an offsetting perspective, they can come imbalanced in terms of where the exchange is over leveraged on one side or the other, and it happens at certain time frames where it's almost like in unison right across the board. Central exchanges all, if they're over leveraged at one point to another, will just buy on their own exchanges, and you don't see any new money coming in. That's the concerning thing. You don't see more Bitcoin coming into the actual market on the exchanges. It's actually just their own buying and selling. So sometimes it's difficult to see that kind of activity when it's not. It's just a trigger point, and boom, then everything else goes on, and market makers just keep pushing the price up. So just interesting, I thought, how fast that pump happened. It wasn't like we've now got a spot ETF or something. We've had regulation that's now changed the whole dynamic and paradigm of the cryptocurrency world. It just seemed too impulsive. But still, we always have to do TA, and we always have to recognize that this is crypto and these things are not out of the ordinary. It's just, for me, when I'm trying to analyze, trying to understand, well, what was the catalyst ultimately? Was it more than one? Was it a few different catalysts? But you see, the volume, look at the comparison. That was the volume for FTX. The volume is half the amount based upon that, yet the pump is comparable. So I just thought it was an interesting thing to think about. But anyway, we've got to crack on anyway. We still got to apply TA and just see how we kind of think the next kind of ideas will start to play out. So I want to start with the Elliott wave. So what you can see and what I'm about to show you is that you could consider a new Elliott wave that's formed. And again, I always say this in the server, that structures can break down, certain ideas can become invalidated, but you've always got to be malleable to the fact that these things can actually change. So what I can see is like this. So this looks to be, you've got, that would be your first wave, and you've got your 5-wave structure within that, and then you've got your corrective wave. So you could choose this to be 2, or even that to be 2. I would probably say that this would be 2, just because of the ABC nature or the correction of your second wave. This obviously, you always look at it's not always the case, but usually, more often than not, your impulsive wave, your motive third wave is usually the longest, and I think you'd find it pretty difficult for anyone to argue against that this could be conceived as a third Elliott wave. Then we've got the 4th wave, and then obviously the 5th wave. Now what we want to try to determine is, if, number 1, is this the end of the 3rd wave, or, if it is, where would we be looking to retrace back to? If it's not the third wave, then where else could we, anticipate moving up to? And then finally, where would potentially a fifth wave kind of finishes off? So if you look at this third wave, you want to see a 5-wave structure within this, and right now, so this is the case for continuation of this third wave. I'm not the only real pullback you could argue is this. Now this is on the 12-hour formation. Sometimes you've got to go down a level, so let's go to the 4-hour. You could argue 1, 2, 3, 4, and then a fifth wave of the third wave. So what I'm trying to do is analyze a case for both the bull and the bears in terms of whether this would be the continuation of a third wave, or whether we could expect to start moving, downwards to a fourth wave, or whether this continues to be the fifth wave. So that's what we've got to try and ascertain. Now, if we were looking, usually, you're going to look at your. I'll go back to the 12-hour. I think it illustrates it a little bit better. Usually, what you're looking to do is use Fibonacci as a way to kind of go hand in hand, I think, in terms of measuring retracements and extensions to this idea. So first we want to look at an extension. So where would the third wave ultimately come to? We've got some other ideas on confluence in terms of being able to figure that out. So we go to the extension tool. We go from our swing low to our recent swing high, and then back to our swing low. Now you can choose this point because it's lower, or you can choose this point. So I think maybe if we start, let's just see which one looks more likely. I mean, you'd probably argue that when you line that up, you can see we are perfectly on that 1.618 here, which is usually, again, not always, but usually where the third wave gets to. However, it isn't uncommon for it to go to 2.618, which is another multiple of that, and then even the 3.618. So we've always got to think about where the potential can go to. Now, the other thing that you want to do is just start to try to align further ideas, but it is interesting that it's literally lollygagging around this kind of 1.618. So we've just got to keep that in mind. And the second thing I want to just do is add in some pivot points. We speak a lot about pivot points, and I've obviously give a lot for what pivot points are, how we use them, and stuff like that in previous videos. So if you don't know what they are, just go and check some of them out. So again, you could look the 1-to-1. We have R2, but it absolutely battered through 1-2. It kind of, when you're looking at this on a 12-hourly level, let's just say, you can see it perfectly hit it. If you were looking at the R2 as a way to take profit, well, we retrace back to here, and then obviously we had the second leg, and then R3 was pretty much near as damn it, just shy of R3. These are the resistance levels in terms of a band to trade between. And then we have R4, which is right on your 618 here, which from a confluence perspective is pretty solid. Now usually, this is the monthly, usually we don't expect to go beyond R2, but you have to map the other ideas out. So that's interesting to think about, just in terms of where we could lead to, in terms of whether this could continue to the upside. Again, you've got your 2.618 here, and again you've got confluence here, in terms of key levels. And more often, without looking at, let's just see if we can add some monthly levels. Let's see if we get anything here. So we have a monthly level at 23,209. Let me just remove these. I don't think these are going to cause too much yet. So yeah, we've got a monthly level, which will be quite a strong level of resistance. Again, right by the 2.618. If it can wick up and maybe come and collect that. Now, the other thing we're going to have is liquidity. So we're going to have liquidity here. We're going to have liquidity here, and we're going to have obviously liquidity around here. So we can map them out on the chart. Let me just take the monthly back off. We shall also remove the pivot points just to keep things nice and clean. And then we will add on. So we on the magnitude, yeah, you're going to have liquidity here. And what I'm going to show you in a sec, I think is quite interesting in terms of the liquidity not being taken on some exchanges, but has on others, which to me suggests that we can still expect to see maybe whether it's this wave. Usually I'd expect for this wave to continue, so making a case more for the bulls than the bears at this stage. I mean, look, I want Bitcoin to succeed more than anything. I think the technology is revolutionary. Blockchain, the complete decentralization, let's just say. A lot of these kind of projects that they are owned and realistically, even though it's decentralized, you're in the hands of a few rather than the many. So with Bitcoin, there really is there's no centrally managed, there's no one entity who holds the key. Let's just say everything is just for the people, isn't it, so to speak? So I want to see Bitcoin succeed, but I always have to go with the narrative. I always have to look at what the macro picture states, and it's always, at least until you see a pivot, because of Bitcoin ultimately can be classified as a tech stock. I think it's hard to go away from that. Why is that the case? Well, number one, it seems to follow the Nasdaq and the S&P pretty much, to the point. It's completely inversely correlated to the DXY, obviously baskets of currencies, mainly the dollar. Again, you see dollar going up, Bitcoin goes down. Dollar goes down, Bitcoin goes up. So whether we choose to believe that Bitcoin does its own thing based on this community of people all trying to push it to the upside or whatever, it's not. A lot of it is pure basic economics. It's risk on, risk off. Whether the economy is made to make people believe that riskier assets are a better play, because essentially money is cheap. That's what it always boils down to. Is the cost of money dear or is the cost of money cheap? And right now the cost of money is super expensive. So what that means is people want to go to the dollar. They want to put their money in less risky assets because it's not cheap, it's real expensive. When money's cheap and it's easy to maintain and get hold of, then people naturally start to fall into a much more riskier category because it's cheap. So that's the simplistic way to think about it. If money is cheap, go for risk. If money is expensive, go for de-risk or off-risk assets. So, like I say, Bitcoin is pretty much following the macroeconomics, the way I kind of see things. So you've always got to take whatever you're seeing with a pinch of salt, and look at the wider picture, specifically with Bitcoin, and then obviously by proxy the altcoins. Yeah, you might get some random altcoin that'll do completely something different because it's community based. Something's just come out, a new credit card or something crazy or whatever, will push the price of that up, or there'll be a pump and dump kind of narrative going on. But if you just take Bitcoin alone, and the major blue chips like Ethereum and Matic and Avalanche and all that kind of stuff, they will kind of follow the trend of Bitcoin. So specifically on the dominance. So back to the idea. So as I say, we've mapped out what we can expect in terms of whether it comes up and collects this liquidity. What I think is interesting. I'm just going to remove the not that one. That right, and we can keep these here a sec, because we're going to try to map out a case for if we retrace back, where can that essentially end up. Now you can see clearly, we've came and collected this liquidity. We rose above it. Obviously we're on the futures, but we rose above, got the liquidity because we spiked above the previous high. Job done, brilliant. Lots of liquidity there. Lots of demand and supply, or supply and demand. So now on to the next steps. But if you go to like Coinbase as an example, you can see that same liquidity level didn't get taken. So that to me suggests we still want to come up and collect that, which is why in theory, this third wave can still continue to the upside, simply because there are no rules that garner it must only go to 1.618, and that's it. You know, it can go to 2.618, 3.618 in some instances. So that's why right now I'm not 100% convinced that this third wave pump is down and out. But you can see obviously on the futures market we are over. So what could that look like? As I say, you know, we've just looked at some further confluence, haven't we? We took out our fib extension tool. We went from swing low, we went to swing high, back down to swing low, which we think is favouring this one because of where it is. If we do move it up, actually, what does that look like? Is the anything? I just think the better one is the one below, just because it's the low, and maybe we even want to argue that this is 2. So wave 1, corrective wave. The only thing about this corrective wave is A, B, C. It's a very small ABC, but still we're on a 12-hour time frame. So maybe if we were to break this down on smaller time frames, it would actually play out to be an ABC corrective pattern, and then, you know, this would be the start of your C wave. Sorry, your 3-wave C wave. So that's interesting. So then, yeah, if we do continue up, as I say, we've got higher targets that could be, you know, look to be hit. Again, we've got liquidity here at the 22,500. We could even push up again to the 26,618, and again, just adding some pivot points for the monthly on the chart. If we just look at where they are, again, we've got we're at this level now. R5 is here, so that would be another interesting area where we may just come up. That would probably, at that level, just clip the liquidity from here. So you can see if we apply the same narrative here, so we're just shy, you can see there we're just underneath the liquidity on Coinbase, but we may continue to the upside, just come out and take that liquidity, maybe hit R5 before we start to move back down. So we'll have to make a case for both of these ideas, right? So if we make a case, if we say that, you know, if I just get rid of that 1 second, if we say that we want to map that out again, right? So we would say that liquidity was just about here. Let me just put the pivot points back on. So we want to match the pivot point with either the liquidity or R5. We can do both, right? But let's just go here just as an idea. If we do come here, we're going to take off the pivots. We'll just make things a bit messy. Where could we potentially retrace from a fourth wave? Okay, so, you know, if we come up, come and collect this liquidity here. Let's take the magnet tool off. Let me just come and do that again. So we could come up, hit the liquidity here, and then whether we come back to 236, 382, or ultimately, which you normally want to see is your 0.5 all the way back down to 18,528. So the question is, do we have a small pump before we come back down here and then finish off the 5th wave again, which you could take the liquidity here, could take the liquidity up here before I think eventually we come back down again, because we've still got a long way to go yet in this economy. And I think, you know, whilst this has wrecked a lot of people and there's, you know, been a really difficult thing to see if your outlook has been bearish and you miss the pump, then, you know, it doesn't detract from the fact that right now we're not sitting back up at the 30, 40, 50Ks. Yes, we can still move up to these levels, absolutely. You know, 25, 26, 28, who knows where we can go. But if we just purely look at TA, then we've got some areas that we can come and hit. So it's going to be interesting to see how that materializes. Let me just get rid of this off the chart real quick. So that's just something to be mindful of. Now, obviously, this is more day, you know, macro trading, swing trading. But what about if we just want to look at like day trading? So ideas around, you know, a couple of 100 points or something, or just something in terms of being able to identify an area where you'd want to get in and get out. So we can I'll leave that on right now just for let's go to maybe like the 15-minute. Now I always like to identify, it's good to be able to identify, in fact let me just take this off. Not that. It's good to be able to identify order blocks and fair value gaps and areas on the chart which are key. But if you haven't got the Lux algo, I suggest it's something probably worth looking at, because it does map out your key zones nicely, and you tend to see just some nice rejection in these particular areas. So this may come out and come and tag this now. That would be interesting to see. Do we hit the order block and then retrace back down to the equilibrium, or even more, go to the order block below, or do we smash through it? We shall see. But one of the things that I kind of like to do in terms of day trading is to just look at the key levels again, just identify where potential moves can bounce from. You can see here, we've got this is an important order block. You can see price got rejected at this point, which is why this has been painted. It comes down to here, and this is that local low, you could call it, where you would suggest you'd buy in, at least on the short time frame, Bitcoin at a discount. But you can see again, so I've painted it here. This would have been a lovely long position at this point, just because as the price has hit, it's painted a new discount level. Prices come up, little small retracement, just in terms of what that retracement looks like. Probably maybe the 318. 382 rather. It got just above the 382, just missed the 0.5, and then has come back down, so back into that zone in terms of being able to just get a nice fill just here. And then if you're longing, maybe your long is that you're going from order block to order block. So that would have been a nice snipe, just getting your order in here, letting it ride up until that's a liquidity grab. You can see that. And again, if you're short on this area, maybe this would be an area where you're short. Maybe you then have a second level here, which you would say, okay, well, I'm going to have my first level at, say, 10% of my account in terms of an order. When I say account, maybe you want to position that where you say, okay, every single trade I'm going to do will only be against a total expenditure. So let's just say I'm never going to, put more than 30% of a trade, on a single trade. So you'd say, okay, well, if I had $100, well, the maximum I'm going to execute on a trade will be $30. So, but of that $30, you may want to split that into two levels. So you may say, okay, well, my first level, I'll do 10% when it hits this level, and then I'll do 20% when it hits this level. Okay, so you've got these two ideas where you're going to have liquidity here. Obviously, you've got liquidity here, and then you're going to have liquidity here. So the idea then could be, okay, well, I will short at this point, and I will take my profit down at this level here. That's a very fair strategy, very fair idea, because these are normally key areas where bulls and bears are changing hands in terms of key levels. Now you can very easily draw these out yourself. You don't need this tool. I would argue that this is an area where you'd have an order block just because of the reversal, but this is just a quick way to kind of eyeball them. These are fair value gaps. This idea where you have a quick move where, from an algorithmic perspective, the market wants to always come back down and see what else is in terms of filling the gap here in terms of orders for anyone who has missed out on an order, because the price action was just really quickly. So as I say, you can use these as a nice way to look at that. But then again, as I say, so you'd short here, and then you'd take profit would be here. Now this idea would be this would be level 1, and then this would be level 2. So if you were going to say, well, 30% would be my total expenditure on any single trade, whatever your leverage is, if it's 10x, you know, your liquidation level is going to be somewhere like right up there. But that's to say, price would have to go from here all the way up here for you to lose that total 30%. So not your total account, but your 30%. However, what you can do is a couple of things really. You could say, well, if this is my second level where I'm going to do 20%, so you've done 10% here, and then you've done 20%, so the two of them obviously would equate to 30%. You could set your stop loss, you know, either at this liquidity level here, because you would expect, or just slightly above the liquidity level, and then you see a return. Or moreover, you could actually hedge long, which is another interesting way where you, for whatever reason, the market wants to continue to the upside, but you still think the narrative is down. Maybe you think, well, the fourth wave has got to come in. This is purely speculative, but if you think the market is still ultimately bearish, you hedge against that. Depending on what platform you've got. I mean, if you look at ByBit, ByBit allows you to hedge with the same coin, so I can long and short at the same time with the same equal value, therefore locking in a loss. So if the price starts to move away, you can, as long as you've got enough margin to cover the long, but if you're only using 30% on a trade, you obviously have, you can lock that loss in. So the idea would be, you know, let's say you have a long, so you've got a short order here, short order there, and then you've got a long order here. So the loss, let's say this is your, let's say you've got a short order here, first one, and then you've got another short order here, and then the average of them two is, so your average order is probably going to be somewhere around here. Remember, that's 10%, that's 20% of your allocation, so your average is probably going to be somewhere here, right? So if price goes up to this level, you get your order filled. You only really need price to come back down to here before you're in profit, right? So just to kind of draw that out, you know, we come up, we get this order filled, okay, but price starts to go against us, so now you're in deficit, yeah, so you're in the red, but then you get this order filled, which means that your new average price is here, right? Which now means that obviously you're more exposed in terms of your overall percentage, but you now don't have to come back down to here to be in profit. You just have to come back down to here to be in profit. So that was a bit messy. So, you know, like I say, what happens then is if you come down to here, you're still going to say, well, maybe your equilibrium is you take profit, or, you know, you're still waiting for here for you to take profit. But let's say it goes against you still, right? So price continues to go up, right? At this stage, you're putting a long in, which equals that 30%. So now, on the face of it, you're 60% exposed, because you're exposed here, you're exposed there with 30%, but you've locked in your loss at this level. So now your loss is your average here, right? I'm just going to take these off now so that they don't confuse. And this here, so this is where your average entry is, and now I'm going to delete that out as well. You've got a long position here. What that actually means is the delta, let's say the difference between here and here is 262 basis points. Now let's say you earn $1 for every basis point the move goes in your favor. So right now you've locked a loss in, okay? So right now you are $262 in loss. Now the really interesting point about where we are at this point with the move is, if you think about it, if price continues to go up higher, right? Now let's say there's another interesting amount of confluence at this level here, just as an argument, right? For whatever reason you think, okay, this is where we're going to bounce. You've done your TA and there's been a number of ideas why you think that's the case. So price continues to go, move up like this. And now you're thinking, okay, what's my current situation? Well, remember, you're $262 down, right, in the red. But if the price if the price continues here, up here, logic would say, well, you are $262 in deficit here, plus an additional 485 because the price continues to go up from your original average position here. So now you're in something like $600-700 in deficit. But remember, you've also longed, okay? So your long position is also in 480 odd in profit. So really your net position is still $262 in deficit. Okay, that's the power of hedging. Now let's say, for example, at this stage, right, let me just take this one off. Let's say at this stage you then say, okay, well, now the price has come up to here and you expect to bounce. You're now going to liquidate this position as a $488 profit, right? Remember, you still now, but when you liquidate this position, I'm going to bring this up. When you liquidate this position, what you've actually got is you've just gained $488, but you're down 748. So you've got to do the math to take the net long from the net short to work out what your actual unrealized gain is. So the idea now is, remember, you need the price here to drop this level, which is $258. So what does that now mean? That now means natural convention would say, well, for me to get back into profit, I've got to come all the way back down to my average entry, which is, you know, where was the average entry? It was here, wasn't it? $256. Yeah, the average entry was here. So let's say what you would do in this scenario now is, let me just mark this out one more time. $259, right? Now what I need to do is figure out where I now get back into a break-even position, right? Because now this is when a trade goes against you, right? This isn't to try to try and get into profit. This is to just try and break even, accept that the trade's gone against you, and ultimately you just want to get into break even, so you're not in a negative position. So we now just need to go 259. So it's there. $259, something like that. Which is now to say at the position here. So you've suggested that you think markets are going to go the opposite way. So now you would sell your long position. So this is now being liquidated. Now what you are is you still remember, you've gained 488, but you now need to remove $259 that you're short of. Well, the price actually only needs to come down to here to break even, rather than all the way down to here where you previously was. That was your original starting position when you averaged in for them two orders, if you remember. So the power of hedging is really about number one, locking in a loss. That's the first component. You lock in a loss so that you are not, you can kind of take a beat, replan, figure out if your narrative is still right. Now you've got to understand on this though that context is important. I mean, if price just continues to rip up and rip up and rip up, it's difficult to find the point at which it's going to return and reverse. So you're always kind of, really to hedge is really good in range markets where you go to a daily open down to like a daily close, and it's pretty straightforward to find these let's call them reversal points where you think the reversal will happen. So there's two ways you can go about it. You can just put a stop loss in and accept the loss, and on a 10x leverage, probably not going to really kill you. It's probably going to be 5, 6, 7, 8% of your account. Easily come back from that. Or you can hedge. So if you was to go higher leverage, which I wouldn't recommend, but if you was to use higher leverage, then a hedge would be a way to kind of help you manage a losing trade, so that at least you just want to try and break even, or even just accept a small loss. So that's just ways in which you can manage the trade. So let me just get rid of them. I hope that was clear in terms of just understanding hedging. It isn't a by any stretch of the imagination, it's not a novice idea. You've got to, well, number one, you've got to be quite decent at trading. You've got to understand your levels. You've got to understand where you expect to reverse from. But is the other cool thing, it doesn't matter if you're wrong, by the way, because if you were wrong with your reversal, you just get back in and hedge again. And remember, you're hedging equal to your opposing position. So if you're 30% short, and that equates to a specific amount of BTC, in this case, let's say it was 2 BTC, for your 30% at whatever leverage you used, your long has to match that. And we could get into doubling up your leverage on the long side if you, but right now it's probably just keep it easy and neat to understand. So that's kind of how I manage it. But from an intraday perspective, as I say, these are really good ideas just to kind of give you something to work between. Two areas on the chart. I mean, right here, this is going to be a tougher area because there's a lot more. You can see the amount of volume. Well, I wouldn't call it volume, but the amount of orders in terms of price action that moved the chart from this point is quite strong and much more stronger than this one. So, we're not. When you look at these, it's nice. You can kind of just say, okay, well. Using these areas for a reversal, and then again using these orders for a reversal to the downside. And if you're wrong, it's okay, you average in at this point. If that's wrong, okay, then you have the stop loss here, accept the loss, or you hedge, and then again just going the way I went is how I'd manage it personally. But if you're not and you're happy, if you don't want to manage it, because managing it's tough, by the way, it's not easy. It sometimes it can go, it can take a long time to manage it out. It's not like, a reversal happens in 10 minutes. It can be hours, you know what I mean? Even longer sometimes, depending on how wide your net loss position is. So, you need to be clinical with your decision making. And yeah, that's kind of just some ideas on how to manage it. So yeah, it looks like we are, just to recap, going back to the 12-hour. It looks like we are right now in a Elliott wave. We can see, we have our 3 waves. We've got our pivots. We can potentially look at areas to retrace back to. I mean, if this is ultimately, like I said before, the continuation of the 3rd wave, then again we'd want to be looking at something like the 2.618. Maybe it's just a liquidity grab for the likes of here on Coinbase. So I'll tell you what, I'll just go back to here. Yeah, so if we are making the case for continuation of the 3rd wave, then again you've got R5, which again is based on your calcs of your pivot points. So we could come up here. We could come and claim, as I say, we've got liquidity here, but we've also got a really big order block, this whole area here, and that's just born out of this liquidity here from this order block that was well actually way back September 22. So quite a big order block there. If we do continue on the 3rd wave still, well, again, we've got the 2.618 here, and we've also got a huge amount of liquidity up here. So again, right now, there's no. If I'm playing this, I'm playing the long game at this moment in time rather than the short game. Going back to the 15-minute, like I said, what I would be looking to do is to have some long ideas. However, you always need to see how reaction is at certain points. So, I'd be looking to long from kind of this area here, and then just letting it push up. I mean, because we are in such a really bullish trend, my order would be in here. I'd maybe consider having a second order somewhere around here, just underneath these areas. You've got a fair value gap here. You're looking for ideas in terms of where you could see confluence. So I'd maybe have my second here, and then I would look to stop out just below these lows here, whether it was whether I wanted a hedge or whether I wanted to whether to just accept the loss. But ultimately, you know, I wouldn't be getting in on a long at this point. I think the move, you know, is too overgone. I'd like to kind of come back and get it back into an area of value. What I would do though, however, is I would let this, if I do get a fill, I would see if it continues to the upside. I would use stop loss management then just underneath. See this, let me just zoom in a little bit. That's a little bit tight. I would move my stop loss just underneath the fair value gap here to clear that out, and then see where it wants to go. If it wants to continue to the upside, again, realistically you would say, well, if you want to get in and out, you can take the profit here. However, based on what we've seen over the past, since like the 30th of December, you just let it run and just keep on raising your stop at key intervals, you know, just underneath the clearance of previous structure. That's how I'd be looking at it. So that's pretty much all I've got for you on this one. It's going to be interesting. We've got, you know, another week to come, and we see what news brings. We see what's going to happen. Yeah, I don't know what we've got actually in the news. Maybe I'll do that as a separate session. And we'll maybe do another YouTube maybe on the week ahead. If you aren't already subscribed, please maybe consider subscribing. I will be doing a lot more content as we move forward. Also, if you want to come and join the server, learn all about TA, understand some of these concepts that maybe you don't really follow too much of what we're saying, but you know, come and learn. Have a lot of good people in the server who maybe like you started off really kind of new to trading, but these concepts are, well, from a technical standpoint, well tutored, and we can kind of do one-to-ones. We cover that. So I obviously run and own the server, so if you feel like you need some education and kind of an understanding on where you are in your journey, then you know, feel free to come over and come and say hi in the server. Lastly, if again got some insane bonuses for anyone who wants to use ByBit. I currently use ByBit. That's my trading platform that I like to use. It allows this hedging idea with the same token, so you can, rather than having to, you know, hedge one way with BTC and maybe use something like, I don't know, Ethereum to hedge the opposite way, or have to use a separate exchange. It can all be done with ByBit, which is what I really like. So I will make sure, so that is in the description as well, so feel free to use that code, and you'll get some insane bonuses. But other than that, we shall leave it there, and I shall catch you guys in the next one. Speak to you soon. Bye for now.